Hello, everybody. It's Gerry Scott from the Snowbirds US Expat uh, podcast. And I'm a little stumbling here today because it's another beautiful day in Maui, and I get to speak to my friends. We've got Davis, and we've also got Ryan, and they are part of EBT, which is a cross-border accounting firm, and they have offices in Medicine Hat and Swift Current. So before we came on air, I had to do a little, as a Canadian, we always talk about how far do we live from the rink. And we were talking about the glory days of Medicine Hat Tigers. And Ryan, I think you said that Swift Current these days is pretty good. Are they a pretty good team?
They're good against the Tigers.
Okay. That's good. I hope that doesn't hurt the office morale when you guys are going back and forth.
No, it's a great rivalry.
Well, guys, I really appreciate your time today, and we're going to get right into it. Today, what we're going to be doing is we're going to be covering a very interesting topic, and it's called basically, and I'm going to jump right into it. And I'm going to ask the question, what is an expatriate? Guys, what is it? Who are they?
That's a great place to start, Gerry. What is an expatriate? Why do we care about covered versus uncovered expatriate? The first step is, what is the definition of an expatriate? So there's kind of two broad categories here. The first one being U.S. citizens. So U.S. citizens become expatriates when they renounce their U.S. citizenship. So that's what we see in practice. Is it's typically assisted by a lawyer. You usually need a second passport of the country where you're a resident or citizen. And it's usually done by making an appointment and visiting a U.S. embassy or consulate abroad. And I think they make you pay a little fee there. And then the result of it is that you get a certificate of loss of nationality. We abbreviate it as COLN, so COLN, not colon. And then the second category is for long-term residents, which we typically know them as green card holders. So to put it in general terms, you're a long-term resident if you were a lawful permanent resident / green card holder for at least 8 of the last 15 years, ending with the final year. And the ways that you can become an expatriate as a long-term resident are the ones that we see most commonly is somebody voluntarily abandoning their green card by filing a Form I-407 with a U.S. consular or an immigration officer. And the second most common thing that we see is a dual resident of U.S. and Canada, and they file a Form 8833 treaty election, essentially to claim treaty benefits of the country where they are resident. And that's usually in reference to Article 4 of the Canada-U.S. tax treaty. So yeah, that essentially covers the definition of expatriate.
Now, when we did a podcast a couple of weeks ago, and then we were talking about, renouncing and how common is it. Are you guys seeing a lot of your clients when a green card holder, as you say, it's very simple, it's easier, you just surrender your green card, and yes, there's a gazillion. You made it sound so simple, but I think the stack is getting bigger and bigger on what these people have to file in order to give up that green card. Is it pretty common, Americans renouncing and the green card holders just giving it up and coming home?
I would say it's becoming more common in the last few years. I know there was a spike in 2019, 2020. A lot of that had to do with the Trump tax changes of 2017. There were a lot of punitive tax measures there, like the GILTI and the transition tax, and I think that kind of resulted in a large number of renunciations occurring in the years following. So yeah, I would say in the last 5-10 years, I think it's been record number of expatriates from the U.S. So it's a topic that's definitely gaining popularity, and it's an important thing to know about for sure.
And Ryan, under the Biden administration, do we still see that as being fearful for a lot of these people wanting to come home?
Yeah, the big issue here is that regardless of party, if you're Democrat or Republican, your easiest target from a tax perspective is let's tax the expat because you're not a swing voter. So if you look at U.S. election and political identity, each state doesn't really care if you're going to tax the guy that doesn't live there, right? So Trump put in the transition tax, he put in the GILTI tax, Biden continued it, never really questioned it. If anything, what we're looking at in the future is that some of the personal tax cuts that that citizens got under the Trump administration are set to expire at the end of 2024. So now there's a big question mark. We've got the election in November of 24 this year. If the Republicans win, there's more likely to be, but not certainty, that, hey, we might extend some of these benefits, some of them being lower tax rates for citizens, doubling of the estate tax exemption, which we'll talk about later and why that's important for renouncing. But outside of that, both parties really have an interest in taxing expats, and they're both making it more complicated to do so, right? Trump put in GILTI and transition tax. The Obama administration put in all the FATCA compliance that really forces other countries to tell the Americans if you're compliant or not, and giving them your tax information. So both sides of the spectrum politically are going after expats.
How soon do people start getting involved with you when there's the intent that they want to become an expatriate or surrender their green card? Is this conversations you have within a couple of years of them coming home, or how does that process begin?
It varies. Some people will be just filing for the last 20, 30 years, and they're just sick of paying the fees annually and they want a way out. They never pay tax because they don't have much going on, but they're 60, 65 years old. And they're like, well, why do I want to pay you every single year? I never owe them money. I have to give them all my bank account information every year. I kind of just want to get this off my plate. So then the discussion is, okay, this is what it looks like to renounce. This is the tax you may or may not pay. Here's some planning we have to do. Other people will come up to us and they say, I've never filed taxes before. I had no idea I had to as an American not living here. And then it's, what does that look like? They hear the fees and they say, okay, well, maybe I just want to file the minimum amount I have to and then renounce as soon as possible, especially if I'm going to owe tax. And then probably the most important group are people who want to become entrepreneurs and start a business, and then they hear about the GILTI tax and the transition tax that was out of nowhere retroactive tax on all your prior year earnings in people's corporations. They go, well, if I'm going to start some businesses, maybe I don't care about my citizenship anymore and I want to get out before it costs me a lot of money. So there's a big varying pool of reasons people want to get out, but the trend is it costs money, it costs tax, it's a headache. I'm scared of the penalties if I'm ever late. I want to be done.
So I could never understand the motivation of the US government. If they're going to tax, they're not really taxing, because if you have a treaty with Canada, there is no, the idea of the treaty is to eliminate double taxation. How much tax is actually, if for an American living in Canada, just your average Joe Blow American living in Canada, how much taxes is he really paying to the United States? And why would they continue to hold on to this special thing they have?
So I'll let Ryan expound on this a little further after I make a few comments. The answer is you don't really know exactly how much tax a person is going to owe each year. It's obviously dependent from person to person. When it comes to things like GILTI and transition tax, we kind of refer to those as punitive tax measures in the US because it's actually on Canadian source income. So there is no foreign tax credit that you can claim. It's just the US taking their cut of the earnings in a corporation for GILTI and PFIX for individuals. I know you're aware of PFIX. Like I said, we refer to those as punitive tax measures because there's really no escape from double tax on those essentially, because there is no foreign tax credit that Canada is going to give you for paying US tax on Canadian source income.
Yeah, and if you think about some of the other motivations, part of the problem is, like, if you look at the GILTI tax, for instance, and some of these other punitive tax measures that cause Canadians to pay tax, some of it is definitely on purpose and some of it is accidental. So for PFIX, a huge chunk of the reason why they tax PFIX how they do is because the US is the global financial power and they want to maintain that. So they make buying foreign investment vehicles as a US citizen unattractive and making you want to use the US financial system to keep that power, even when you're living abroad. So there's there's a bit of geopolitics on that side of it. But on some of the other measures, like guilty tax, for instance, really the intention was to go after like S&P 500 level companies like Apple, who had all their money hiding in Ireland, and the guilty tax was a way to force them to repatriate these funds. That was the whole concept of transition taxes. Well, we're going to tax all these big countries, all these big companies that are hiding their money abroad, and force them to bring it home. They'll invest in America, and we're going to increase our tax base. But what they didn't do was add a de minimis for $30,000 to $50,000 of profit at the end of the day once they pay all their expenses. And now suddenly they're subject to American tax that was really intended for someone like Apple. You look at some of these other taxes where tax-free savings accounts are taxed for U.S. purposes. So here's another accidental tax. Canada gave you this tax benefit when the treaty was negotiated between countries. The U.S. never really considered it, so now it's just by default taxable in the U.S. You're accidentally paying some tax, and then if you're looking at the American government in total, they spend way more than they take in. So politically, no one really wants to address that issue, because all you're going to do is increase your deficit by giving a tax break to someone who's not a relevant voter for you.
And once again, I'm going to ask you guys this question because everybody has a different opinion, and we tell Americans that you should not own a TFSA. Do you guys agree?
Yes.
Yep.
There are some instances, if you're going to keep your citizenship, where it can make sense, but it's pretty contextual. It can make sense if you fully utilize all your RSPs. You pay a very high rate of tax in Canada, where you've already got a really large non-registered portfolio that's going to generate enough foreign tax credits where you can shelter the tax on your US return, because you've just maxed every other tool out, and you're already paying such a huge amount of tax in Canada that the differential in tax rates between the two countries still can make it worthwhile. If you're the average person, it doesn't make any sense. You're never going to be in that position. These are for people that have $10 million sitting around in a non-registered account that just don't have any other options. If you're the average person, all you're going to do is pay us more money to file more forms. Each of those forms, there's two you have to file, a 3520 and a 3520A for the TFSA. They each carry a $10,000 late filing penalty. So you're worried about that all the time, and you have to pay tax on it. So not only did you not shelter any of the income you earned, you just paid it to a different government. Now you're paying your accountant more money to report something that you could have just held personally or in an RSP.
Well, we take the same stance on the TFSA. There's no doubt that, and it also leads me to another thing. When you talk about PFEC, a lot of times we get called in because the clients, Americans living in Canada, have got Canadian mutual funds. The advisor, and I use this word a lot, charming, intelligent on the Canadian side, and they just don't understand that U.S. person has to file the 8621. If I not being an accountant, I believe that's the form that they file, 8621.
Correct. Yep.
And it just leads to additional costs to be compliant, and it's so easy to work around that PFIC problem. So that's probably the number one reasons why people, the accounting firms, do call us. My real job, which is as an advisor, cross-border advisor, which I'm very careful with compliance and all these things, make sure that I'm not misleading anybody. But anyhow, so the other thing that and I think we got into it a little bit was the definition of being covered and not being covered. So non-covered during or being covered. And I think we got into it a little bit by saying, so a non-covered person would be a green card holder. Is that correct?
So that's not necessarily the case. So
Okay.
step one, you kind of go back to definition of expatriate. Once you've expatriated, then whether or not you're a U.S. citizen or a green card holder, long time resident, then you need to evaluate whether or not you're covered or non-covered. So non-covered is easy. That's what we more commonly see. And and it's essentially anyone that's not a covered expatriate. So to determine whether or not you're a covered expatriate, there's three big tests that you take a look at. So the one that people are probably most familiar with is the net worth test. And that's essentially if you have a net worth of $2 million on your date of expatriation, then you're a covered expatriate. And that's net of liabilities as well. So you kind of whip up a balance sheet for yourself. You got your assets, you got your liabilities, and then your net worth. If it's over 2 mil, you're a covered expatriate. The second big test of the three is the tax liability test. So that takes a look at your average annual tax liability over the last 5 years. As of 2023, if your average over those last 5 years is over $190,000, then you're a covered expatriate as well. Then the last test is a certification test. So this is in reference to Form 8854, a line on Form 8854 that asks, under penalties of perjury, do you certify that you've been compliant in your taxes for the last 5 years? And you have to check yes on that to not be considered a covered expatriate.
Okay, and the process, if you're covered to go through that renouncing process, it's a bigger process. There's more work involved.
Yeah, there's definitely more work involved. If you're non-covered, you're generally just filing your Form 8854. You're providing some basic ID info as required by IRC code 6039G, I believe it is. So you have to give them your TIN, like your tax identification number. You have to give them your address, your country of residence, just a bunch of basic information, some income and asset / liability information, but there's no additional work needed. Essentially, you file your Form 8854, you make your certifications on there, and then you're done. If you're a covered expat, there's quite a bit more to it. You can be assessed exit tax if you're beyond the threshold, which I'll let Ryan dive deeper into that.
Yeah, so your big problem is if you become a covered expat and you're either about to renounce or you've renounced, nothing's going to change. The biggest thing that happens is you're deemed to have disposed of all your worldwide assets at fair market value. So two things happen. One, you have to take a listing of all of your worldwide assets, assess what they're worth, convert that to what that would be in US currency. And then you have to find out what you paid for everything you owned, which for some things is pretty easy. For a lot of other items, it would be fairly hard if you've owned them for decades. And you have to assess what would that cost base be for US purposes under US law. Then you're assessed the capital gain for whatever that differential is, right? So for someone who's worth $2.1 million, if most of that net worth is in a stock portfolio that you've had for 40 years, maybe your cost base is 400,000, it's turned to 2.1 million. Well, you're going to pay tax on that gain in the States when you renounce. Now there is a little bit of relief. They have a capital gains exclusion right now for 2023 filers. It's about 821,000 USD. So even if you were a little over that $2 million threshold, or you failed one of the other tests, say you had $500,000 of capital gains on your net worth, you're still not going to pay any tax. But this becomes a really big issue for people that are of higher net worth. And on top of that, not only do we have this deemed disposition, but if you've got certain retirement accounts, deferred compensation accounts, each one gets individual treatment, and it can get pretty complex. So you might want both a tax lawyer and a cross-border accountant looking at this. But in some accounts, you're going to be deemed to have received the present value of whatever that pension account was worth. Or if you have a trust, you might be deemed to get the value of that trust all in one lump sum. So it can really increase your effective income for that year that you've renounced, and give you a nasty tax shock on the way out the door if you don't plan properly.
Now, how complicated is it? And I come across a lot of these people. They're dual citizens. They live in Maui, and they live in British Columbia, or Ontario, or wherever. How does that work? Like, which is you're filing tax returns in both countries. How does that work?
So if you It does somewhat depend on your residency status. So we'll assume you're a U.S. citizen and a Canadian citizen / resident. If you are spending most of your time primarily in Canada, or say you're about 182, 183 days in each country, you're equally split. Really what you have to look at is the treaty tiebreaker rules, which is the first tiebreaker is, where do I have a permanent home or a home of abode? Well, if you have that in both countries, you don't really tie break anywhere else. So you go to the next tiebreaker, which will end it for most people. And that is, where is the center of your vital interests? So that's, where are your economic assets? Where is your economic income coming from? Where are your relationships? Is your significant other 100% in the US and you're 50-50, or are you guys moving together? Where are your friend groups? Where are your social clubs? Where are you a member of? Do you go golfing more in Canada, or do you go golfing more in the US? Where's your gym memberships? Like all these factors play a role in answering that question. And for some people, there's usually a pretty clear answer. For others, not so much. But typically, you can only really have one country of residence, but because of your dual citizenship, you're going to file in both countries. And so the remedy for not being a resident of both countries is to do that tie-breaking process. You can run into issues with states, because states don't have to follow the tax treaty and therefore don't listen to any of the tiebreaker rules. So even if you've done everything properly at the federal level, say you go to California, you like going down there for half the year. Well, you go over the 183 days, California might say, yeah, that's great. The IRS doesn't say you're a resident of the US, but we do. So we're going to tax you on all your worldwide income. So that's really where you get in trouble. But one of the things people who are renouncing want to know is, well, I still want a snowbird down there. Maybe I don't want to stay over 183 days, but I've got a place in Florida. I've got a place in Hawaii. I want to keep going there. I've got a lot of friends there. I'm going to be in Canada when it's warm, but when it's cold, I'm going to go down there. The great thing is you really don't lose access to that, right? What happens is Canadians get the right to go down there for half the year on just a general visitor visa, and you don't have to apply for anything. And then every single year when you go down, there's a 3-year substantial presence test that you do, where you include 100% of the current year days, 1/3 of the prior year days, and 1/6 of the second prior year days. And if that number is over 183, all you do is you file what's called the closer connection form, Form 8840, and you just say, yeah, I'm closer connected to Canada. Here's where most of my interests are, my bank accounts, everything like that. You tell the IRS to say, okay, great, you don't have to file a tax return. Just give us that form every year, and that's all you got to do.
Well, apparently there's an app out there called the Snowbirds US Day Tracker, and you've actually just done a great job explaining exactly what our app does. So the check is in the mail. Thank you.
Yeah, well, it's a really handy tool to have, because if you're over that 183 on the substantial presence test, you're going to know all I got to do is file this form. And if you get over, oh, well, now you have to file an actual tax return and tell them why you don't owe tax. I should mention, if you have to file that treaty return, you do have to do all the same disclosures as a US citizen would have to, even after you renounce your citizenship. So it's a great tracker to have, because you don't want to accidentally go over the 183, file just a treaty return, miss all your information returns that you would have had to file, and end up with a penalty for no reason.
The number one call that I get on the app is that these snowbirds that are down south are telling me, yes, I get the 8840 filing and the current year and the 2-year look back, but they keep on telling me that there's a 12-month rolling calendar on the immigration side. It doesn't exist.
Yeah, really, it's on the immigration side. Like, people confuse the immigration and the tax systems all the time.
All the time.
And you'll see it where, you're right, you can overstay and technically might be an illegal alien for immigration purposes, and you maybe self-deport before they know that. But from a tax perspective, they don't really care. You're a resident. It doesn't matter if you're here legally or not. And the same works the other way, right? Like, they're two separate systems. They have their own concerns, their own laws. And when we're talking about tax laws and the 8840s and the snowbirding, the immigration side's not what we're talking about. People seem to conflate those two all the time, but they're really distinct.
you know, and sadly, there's apps being created that allow you to track your 12-month rolling calendar. And we keep on telling people it doesn't exist. It's out there on websites. There's a 12-month rolling calendar from an immigration point of view. The immigration is concerned when you enter the country, you're entering the country in most cases on a B2 visitor visa. They're issuing an I-94. You've got 6 months going forward. If you go home for 2 weeks and then come back in the United States, that I-94 could still be ticking. People believe there could be a 30-day rule there if you leave the country, but once again, I always love to ask that question amongst accountants. Tell people that the 12-month rolling calendar for immigration does not exist. So for the average snowbird, it doesn't exist. But there is a 12-month rolling calendar on the tax if you have entities that you have to be concerned about.
Yeah, that's a big deal for deciding if a corporation has a permanent establishment in the US.
Exactly. So, like I say, these podcasts get sent out to people because they're so confused. They take immigration, they take tax, they put them together, and I'll tell you, it is they're making it hard on everybody. And I guess the other thing is that when they talk about immigration, and then they're talking about tax, they think they can be so right. And in theory, they're right about immigration, they're right about tax, but they're not right about putting the two of them together. So another question for you. Explain to me how these foreign tax credits work.
Yeah, so what happens on the US perspective is you have a couple basic types of credits, and there can be some other ones, but that's probably outside the scope of your average person. So typically you have foreign tax credits on what we would call general limitation income, or think of that as earned income. That's your wages, that's your pensions, that's income that you had to work for. Canada would call that earned income. Your other basket would be passive income, so rents, investment income, things of that nature. So what happens is you earn your income in Canada, you pay your Canadian tax on it. Then it's time to file your US tax return in US dollars. And you say, okay, here's the total tax I paid in Canada. Of that, what percentage of this tax did I pay on each kind of income? So you split that out and you report that to the IRS. And what they do in essence is they say, okay, great. You made $100,000 of income. Let's say you paid $30,000 of tax. You split that between the two pools. You report that income on your US return because you're required to report all worldwide income. But you also get a credit for every dollar that you paid in Canada. So what happens is you're not going to pay tax twice on average if you don't have any of the other problems we discussed earlier in the show. You'll pay tax at whichever country has the highest tax rate. So for a typical, all I have is I'm an employee, I get a T4 every year, I have no other income or deductions on my tax return. What should happen is you pay your tax in Canada, you report that wage income in the US, you report the tax paid. It's fully offset because on average, Canada has higher personal tax rates than the US. What happens for a lot of people that have TFSAs and other sources of income what's treated differently in the country is that all of a sudden the US tax rate is a little different, or the tax is assessed differently on an item of income. So one of the big ones that Canadians take for granted is principal residence exemptions. I can make any amount of gain on my principal residence in Canada, and it will be exempt from tax if that's the property I designate that exclusion to. The Americans don't do it that way. They say you get a $250,000 US exemption per person. So if you're filing jointly, it's 500 grand off the capital gain of your property. But then that's it. The rest of it's subject to tax. So then you run into an issue where, okay, well, I have some tax credits in Canada. Let's say I had some dividend incomes, so it generated some passive tax credit that I could have put on my US return, but I didn't have a large capital gain. So I didn't generate any tax credits. So now when I file my US tax return, I'm subject to what you might call double tax, but in essence, it isn't. It's just that in Canada, the income is exempt, and in the US, it's not. So when people say, well, I get a foreign tax credit for that, for basic scenarios, that's right, and it works pretty well. But once you get into the more uncommon situations or differing differing tax treatments between countries, suddenly the foreign tax credit system doesn't work as well as what people think it might.
You know, it's interesting. You brought up principal residence in Canada for a U.S. person. Yes, you get the exemption in Canada when you're filing your tax returns, but you're going to have to report that on the U.S. side. And I was with a few realtors last week, and they were talking about the 1031 and how you have that ability to roll over your capital gains into a new product if you use this service, these intermediary services. And it was very interesting because they were talking about Canadians doing it. And I mentioned, no, I don't think so. And sure enough, not only do you have that tax that's withheld, it's called FACTA or some kind of, it's 15% in the state of Maui. So on a $4 million home, you're going to get $600,000 withheld. It's going to take you a year to get that money back, providing all the certificates have been filed with the IRS. But then you don't get the rollover. And if you do get the rollover, you're going to trap a capital gain in the US property, but you're going to have to pay the capital gain on the Canadian side. So I think a lot of times what happens when you ask these people, they say, listen, is this eligible for a Canadian? Well, maybe if the Canadian is no longer living in the States and they live in the United States and they're considered to be residents for tax purposes, it's a different story. But I think sometimes what happens is that these accountants don't have all the information in order to be able to give the proper answer. So that came up the other day in the 1031. If a Canadian is listening to this and they have homes in Scottsdale or the Carolinas or Maui or wherever, please, the 1031s do not work for those Canadian snowbirds. So anything you want to add about the 1031?
We've had a couple clients that almost ran into that trap. Luckily, they approached us first to see if it would work. There seems to be some confusion that you can just exchange the 1031 rules in the US with replacement property rules in Canada. The case, especially when we're talking about foreign properties. Even for US purposes, there's a bunch of restrictions when you're not an American, but you have American property, or you are a US citizen, but you're exchanging different types of properties. It gets really complicated when you're trying to get both countries to align on that topic. And typically the answer is, this might not work out the way you thought it was going to.
You know, and once again, the key, you know, if you're hearing information on our podcast, I always tell people you really do need to check with your professional, your accountant, your cross-border accountant like yourselves, or check with your immigration lawyer. You know, we never sell ourselves as being accountants or immigration lawyers. Yes, we have a lot of information, enough information to be dangerous, as they say. But the main thing is make sure you do check with your professionals because I do the same thing. When I came across this 1031, first thing I did was I was able to reach out to one of our partners like yourselves, and they said it straight that no, you're going to trap a capital gain. If you did it, you could trap a capital gain, and good luck. You've already paid the tax once, you know. So now you're going to have to deal with double taxation. Before we get you guys back to your jobs, and we appreciate your time, what else are you seeing in your firm that you guys are really specializing in that you can kind of share with our listeners?
Well, we're growing quite a bit in the cross-border space. We just started, Davis and I have been expanding into dealing with Australian expats as well as Canadian expats. So that's been pretty exciting. Lots of learning on that front. We've got a lot more businesses going into the US now, especially in the oil sector. That's becoming a lot more common. And then, like we said at the top here, a lot of people are getting interested in renouncing their citizenship, and that side of the business is just continuing to grow. It's been pretty exciting.
For those that don't know, the Australian tax year goes from July 1st to June 30th. So that's just an interesting little tidbit that throws a bit of a wrinkle into the Australian US world. But it's like Ryan said, it's been kind of fun to dabble into.
Well, it's an interesting field that we all work in, and I'll tell you, to have an opportunity to work with your firm is it's a great asset for us. So we appreciate everything you guys do for joint clients that we work on with together. And if our viewers and our listeners want to get a hold of you, what's the best way to get hold of you?
You can reach out to our office. We've got a couple of ways to do that. You can just go to ebtca.com. We've got both a list of contact information there by principal, by specialty, as well as a portal that you can send queries to us. Or you could give us a call at 403-526-5011. And yeah, we'd be happy to help with your needs.
Now, if I asked you guys, if we had to do a webinar tomorrow, what would it be on in the cross-border space? What's the biggest thing you want to cover in a webinar?
Biggest topic, I mean, our bread and butter is really the US expats living in Canada.
Yeah, that would be a big one. We see a lot of non-residents with properties in the US. That's a fairly common thing if they're earning rental income or if they sold a property. Those are fairly common things that we see.
And when an American moves to Canada and they have their PR, they get their PR status, it's almost, is it easier for them to become citizens of Canada? Because then they get to vote and all the other beautiful benefits you get. Do you see a lot of that out there right now? I know there's a great app out there called the Canada Physical Presence Tracker, which is the sister app that we created a few years ago. I had to put a plug in, sorry.
We see a fair amount of people getting their PR cards. Honestly, one of the trends we've seen, and I'm seeing it more in the news now, getting a lot of permanent residents who then leave Canada not long after getting it. It's been an interesting dynamic where they come over, and then after a few years they're heading back.
So they get their PR. So they get their PR cards and they don't follow up with citizenship, and then they leave. Is that the idea?
Yeah, they get their PR card. We've got a couple where they're hanging on long enough to get their citizenship, but lots of them are heading back, and it's typically more the guys coming from Europe and Asia. They tend not to stick around too much. The Americans typically do. They're coming up here, and then for them, their challenge is, okay, do I want to remain a dual citizen or not once I get this?
Okay. Well, gentlemen, I really appreciate your time today, and thank you very much. And I always end every podcast in telling people, oh, go ahead, Davis.
I was just going to ask if you would let me do the honor of signing off. I've been listening to your podcast, so I know exactly what you say at the end, but if that's sacred and you want to say it.
Please do.
The world is small. Be kind to all.
Oh, that brings tears to my eyes. Guys, thank you very much for your time. And it is so true. So my commitment is to see you guys one day. I'm going to get my pickup and I'm going to make my way across the country. I'm going to take you guys out for a beer. So thank you kindly.
Awesome.
That's great. Thanks for having us.
Thanks a lot, Gerry.
Okay. All the best.